Hi everyone, I'm going to discuss about the cost structure of the BPO industry, particularly one company which we can call them CNOS or CNOS. Just a quick overview, the business process outsourcing industry has become a significant contributor to the global economy, offering a range of services from customer support to back office operations. So one of the primary reasons companies prefer BPOs is the potential for substantial cost savings. So imagine a US-based company, for example, that's wanting to outsource, but then doesn't want to undergo the technical, difficulties of opening a branch and everything in the Philippines. So the BPO is one of the strategies for cost saving, especially in terms of labor costs. So understanding the cost structure of the BPO industry is crucial for both service providers and clients to ensure competitive pricing and quality service delivery. The cost structure of a BPO company is normally composed of the following cost types. So one, the labor cost. This is the largest expense, covering salaries, wages, benefits, and other employee-related expenses. So this varies by location, skill level, and service type, and if they're accounting or IT or audit and compliance. Next one is infrastructure costs. So these expenses are for the physical and technological infrastructure, such as the office space, workstations, computers, internet, and software. Next are the utilities and maintenance. So this is the cost for electricity, water, facilities, facility maintenance to ensure smooth operations. Also, we have administrative and overhead costs. So these are expenses for management, HR, for hiring people, finance, marketing, legal fees, insurance fees. So any other fees that's not directly related to labor, it's either administrative or overhead costs or utilities, maintenance, or infrastructure costs. Other costs may include trainings and developments, compliance fees, so our recommendations for cost optimization. So to complement and enhance effectiveness and efficiency of the CONS company, which currently uses cost plus pricing, we recommend implementing activity-based costing. So why activity-based costing? First of all, ABC allocates costs based on the actual activities that drive costs, offering a more accurate picture of the true costs associated with each service or product with more precision. So for example, an employee that has typically 160 budgeted hours for a whole month, but actually works on 180 hours because of extra time working on deliverables and things like that. So the company can charge more than what it currently charges. Like currently it is a steady 15% based on a fixed amount or for the basic rate for the employee, but using activity based. And if, for example, in my example, if the employee is utilizing 180 hours for a month, using 180 hours times the basic rate per hour for that employee, that could lead to more or increased revenue and profit eventually on the part of the BPO company. So by ABC, by identifying cost drivers and activities, it helps the company understand which processes are more costly and which are more efficient, leading to better decision making and process optimization. So for example, because the main driver for the BPO company are the labor costs, analyzing for example the utilization hours for each employee, they would see which employee has excess hours which they can pitch in for example to the client to have more, not have more work, but to be utilized more based on their skills and experience. For example, if that employee currently is a senior accountant but is only utilizing like 80% of the budgeted hours for the month, say if out of the 160, then the 20% that person can be used to other like processes like financial planning and analysis to have a to help with the process and then understand as well enhance your understanding of the operations of the company. So with detailed information on the cost of each activity, you can pinpoint areas to reduce waste or improve efficiency.
Hello, Cemetery Zone, a key player in the engineering, procurement, and construction industry. Today, we'll take a closer look at how the company manages its costs, the accounting principles it follows, and some recommendations to improve its financial efficiency. Cemetery Solar has been in the EPC industry for 17 years, specializing in solar energy solutions. Despite its experience, the company does not have an official mission or vision statement. This is something to consider as clear financial goals are crucial for aligning accounting practices with long-term strategy. Cemetery Solar follows the International Financial Reporting Standards, specifically IFRS 15 and IAS 2. IFRS 15 states that revenue is recognized when the project is completed or a key milestone is reached. Meanwhile, IAS 2 ensures that inventory such as solar panels and wiring is recorded as an asset until it is used in a project. These standards help ensure financial transparency and compliance with global accounting rules. Cemetery Solar classifies its costs into four main categories. Direct costs include materials such as solar panels, inverters, wiring, and labor. Indirect costs covers project management, logistics, and compliance expenses. Variable costs, on the other hand, fluctuate based on the level of activity, including labor and materials. And finally, fixed costs consist of office rent and salaries for employees who are not directly involved in projects. Proper cost classification is essential for accurate budgeting and profit tracking. Let's break down the cost of installing a 5 kilowatt solar system, which sells for $8,000. The cost of solar panels amounts to $3,000 while the inverter costs $1,200. Wiring installation adds another $1,000 in labor expenses, assuming 4 workers earning $150 per day. Total $600. Additionally, indirect costs, which account for 20% of direct costs, amount to $1,160. This brings the total cost to $6,960, resulting in a profit of $1,040 and a 13% profit margin. Symmetry Solar's accounting methods offer several key advantages. First, they ensure transparency and compliance, which builds trust with investors and stakeholders. Second, they allow for accurate profit calculation by properly tracking both direct and indirect costs. These methods also support performance tracking, helping the company identify inefficiencies in operations. Lastly, revenue recognition is aligned with project milestones, ensuring that revenue is recorded only when obligations are met. These benefits contribute to financial stability and better decision-making for the company. Despite these advantages, Symmetry Solar faces some challenges. One of the main issues is overhead complexity, as indirect costs may not always be allocated accurately, leading to potential miscalculations in profitability. The company also experiences cash flow issues since revenue is only recognized when projects are completed, which may not always align with actual cash inflows. Additionally, Symmetry Solar does not currently use activity-based costing, which will provide more precise cost insights and improve financial efficiency. To address these challenges, several key improvements in costing strategies should be considered. To enhance cost accuracy and efficiency, we suggest several strategies. One key recommendation is activity-based costing, which assigns overhead costs based on actual activities rather than broad cost pools. For example, if procurement accounts 40% of overhead, but the project only requires 30% of procurement time, costs should be allocated accordingly. Another useful approach is just-in-time inventory management, which reduces storage costs by ordering materials only when needed, leading to improved cash flow. Implementing standard costing with variance analysis can also be beneficial as it compares actual cost with expected cost to identify inefficiencies and improve resources allocation. Furthermore, the use of rolling forecasts will allow Symmetry Solar to adjust cost estimates quarterly, ensuring that the company remains competitive in a fluctuating market. And finally, conducting cost volume profit analysis will help the company determine the break-even point for each project, ultimately leading to a better pricing strategy and profitability assessments. By implementing these strategies, Symmetry Solar can improve financial control, reduce inefficiencies, and increase profitability.
Here's a quick recap of the accounting principles used across industries. For CNOS, BPO industry, uses cost-plus pricing, adding a 50% margin to actual cost, ensuring transparent pricing but lacking flexibility in market-driven pricing. For San Miguel Brewery for manufacturing, implements standard costing, providing cost efficiency but requiring constant updates to reflect actual cost. For Cisco Automations and Systems for R&D software development, applies cost-based pricing with actual costing, ensuring cost recovery but limiting pricing flexibility. For Symmetry Solar, uses actual costing with 30% margin, ensuring financial stability but facing challenges in cash flow management and overhead allocation. While these approaches help businesses maintain profitability, these are areas for optimization to improve financial efficiency and competitiveness. Key takeaways and challenges. From our analysis, we identified several challenges. The first one is overhead cost allocation issues. Many companies struggle with accurately assigning indirect cost, leading to potential mispricing. Second is market adaptability. Cost-plus and standard costing methods don't always align with market fluctuation, potentially resulting in lost revenue opportunities. The third one is limited use of advanced costing methods. Many companies don't utilize activity-based costing or value-based pricing, which could enhance profitability and customer-driven pricing strategies. To address these challenges, we recommend several optimized costing strategies. Recommendations for optimizations. Based on our findings, we suggest implementing activity-based costing or ABC. Provides more accurate cost allocation based on actual activities rather than broad estimates. Adapting value-based pricing. Shifts pricing models to reflect customer value and market demand rather than just cost-plus formulas. Utilizing rolling forecasts. Allows companies to adjust pricing strategies based on real-time market condition. Leveraging just-in-time or JIT inventory. Reduces excess inventory and lowers holding costs for manufacturing and EPC industries. Integrating lean accounting practices. Helps company minimize waste and enhance operational efficiency. By implementing these strategies, companies can enhance profitability, improve financial accuracy, and gain a stronger competitive edge in their respective industries. In conclusion, effective management accounting plays a vital role in cost control, pricing, and financial sustainability. While traditional cost-based methods provide stability, integrating advanced cost management techniques can lead to greater efficiency and long-term profitability. Thank you for your time, and we hope this presentation provided valuable insights into costing strategies across industries. Let's continue striving for smarter and more effective financial decision making.